Hey guys, welcome back to the Go Global World Investor Series. And guys, I'm going to be 100% honest. It's been a few weeks since the last one, but we've had all these amazing things going on. We have more people onboarding to the app. Things like the all-female shark pitch and all of the other theme pitches are going well. Building that brand identity. And yeah, guys, I have some stuff going on in my personal life as well. Like I have the Texas nonprofit for the venture lines going on, but it's okay though. We got all sorts of new things lined up because this is my first responsibility is to bring you guys all different angles and the amazing things going on in the world right now. So, guys, with that being said, I'm going to be introducing you guys to a fund that really leverages the concept of the emerging manager. And like you've heard every VC on Twitter, they say that the system is corrupt and somebody's trying to disrupt it, but nobody really tells you how, which is why I really hate that app. But I'm going to hand it over to a person that not only helps train emerging managers, but will be disrupting the classic fund structure of VC in a very important way. So I'm going to be handing it off to Hanson Schultz of the Echelon Fund.
Thanks, Chris. Happy to be here. Appreciate you allowing me to be a part of the show today. So,
Yeah, yeah.
um, yeah, looking forward to the conversation.
Awesome. So I guess with the Echelon Fund, so obviously we're talking about a player in a fund that maybe not that many people know about or have proper education. So how did the Echelon Fund kind of come about, and what are you guys aiming to do?
That's the really exciting part about it, Chris. We we came together, my two other co-GPs, actually by what's called the Fund School. So Jeff McDermott is a serial entrepreneur and venture builder, has an incredible LinkedIn presence, and Shabam and Patrick and myself all found ourselves in a situation where we were looking to do something more, looking to learn the ropes in the VC space, and none of us really had, I guess, the right methodology to do that. So Jeff has this program called the Fund School, and it's an ecosystem of different fund opportunities from real estate to venture debt to VC, which is where Echelon fits into the equation. And we were presented with a unique opportunity to come together from literally opposite ends of the globe. Patrick's in London, I'm in Birmingham, Alabama, and Shabam's in Austin, and to develop a $50 million fund of fund structure. So really excited to launch that. We launched about a month ago, and are ready and poised to essentially deploy all $50 million of that capital as soon as our coffers are filled. So excited about that, Chris.
Yeah, and in regards to what you were saying, right? Yeah, so typical venture capital, the barriers tend to be very high, right? Like a lot of people tend to think like the only way is to either one, just be rich just off of life circumstances or slave away as an investment banker. But I think we're starting to see the kind of emergence of people getting that education from the more experienced type of people. And I believe you guys are the pioneers for that with the fund school and all that other thing. So can you kind of expound on the concept of an emerging manager, like what that means and how somebody gets educated to be a good one? Because you can always be a bad one, but then you're gonna lose the
Yeah,
favor of your LPs and you got to go do something else.
absolutely. That's an awesome question, Chris. So I think first and foremost, we're seeing the tide shift in the investor world as a whole towards emerging managers. You're seeing that these emerging managers that are out there tend to have much better success when it comes to the bets that they're making with their different investment asset classes. So I think that's something that people need to kind of overcome first and foremost from a barrier perspective. And then you hit the nail on the head. The traditional VC route is one of three things. You're either got a great exit and you were a founder, and now you're ready to go and invest in other founders. And I think that's probably my favorite methodology, just because there's a little bit more understanding of the market. And then you said the other two, the investment banking route, which is just an absolute grind. And then you inherited it, and you're using daddy's money to hopefully go return a little bit of the profit here. And so with the fund school, we kind of bypass all of those options, and we get the opportunity to, invest upfront. As a GP, I have money behind this. But with Jeff, he's an established investor. He has a track record, and he can be sort of the managing partner. Whereas my other co-GPs, we can learn and literally do everything from bringing the coffee to signing the checks in a method that is, totally unlike anything else in the VC world or the fund worlds. So yeah, it's awesome.
Yeah, and I guess just doing a little bit of research on my own and like the emerging manager concept, I've noticed a little bit quantitatively that people start like emerging managers that kind of have that background, that blueprint that you were talking about. Those type of funds tend to withstand down markets a whole lot more, because
Exactly.
if you just have somebody that doesn't have it just has solely institutional experience. Like I've talked to a lot of associates and people that their first job was VC, and then stuff hits the fan, shit hits the fan. Hopefully YouTube doesn't block me for that statement. And then they wonder what went wrong. And yeah, no, I think I think that's a good thing what you guys are doing, because it keeps the barrier to entry lower, not from a quality standpoint, but VC as an asset class, a lot of people don't understand. Yeah, it's rare, but a lot of things that we kind of have right now can't be in place if we didn't have VC. Like people go to Walmart, I wear Under Armour in the gym and other things like that. So I'll always be an advocate. Now, am I an advocate of a broken system? No, not necessarily. Like you see people kind of putting money together and then investing in companies that they know are going to fail because they're not giving them support, and that's not looking out for anybody. So in regards to the Echelon Fund, what are you guys looking to invest in out of this fund that has all this expertise?
Yeah. So let me touch on one thing before we go into, sort of our asset class matrix. And you kind of broached the edge of this, Chris, but I think it's important to realize that in the emerging world, we also have in the emerging manager world, we have something to prove too, right? And so there's a hunger factor that's a little bit unique in that world, particularly in the VC space. Not to say that these other guys aren't hungry to maximize profits for their investors too, but like I have something to prove. I have my climate tech background, my financing background, my unique skill set to put these different funds and these different asset classes to the fire using my leverage background, just like Shabam does from an operator standpoint and the startups that he co-founded and been a part of, and then Patrick, he's got MarTech experience. So we each have like very unique skill sets to come forward, and then combine that with our managing directors and their backgrounds, and you spin all that up together, and that's an incredible resource pool to draw from to fully vet the potential investments that we make, and segueing into what exactly we're looking at. So I mentioned it's a $50 million fund of funds. And I'll say right off the bat, most people kind of recoil a little bit when you hear fund of funds, because they think of a fee stack. And the way that we're set up is we're essentially 0-18. So most funds are 220. You take a 2% carry of the AUM. In our case, we are just taking we're taking that off of the back end. So we pay back our carry out of my personal carry from or to all of our LPs, which I think is an easy way to navigate around that fee stack. So second to that, we've split the 50 million into 3 different asset classes in a way to both hedge risk and also make sure that we return capital as quickly as possible. Because otherwise, I don't get paid either, you know? So because this is not my full-time gig, I am even more incentivized to make sure that the horses that we bet on, or rather I should say the stables that we bet on that have, you know, a full house of horses, have those 100Xers that are hidden in there. Because I want to bet on that horse trainer that's doing his job really damn well, because I could really care less about the individual horses. Now, how they vet those individual assets that they're investing and how many bets they place, that is crucial, because we want to make sure that the way that they're mitigating risk makes sense. That trickles all the way up to, you know, our ultimate fund structure. So we've got 50% as VC, and that is striated between pre-seed and early stage investments, your middle stage Series B and C, and then late stage investments. And each of those have obvious benefits from a, you know, possible return matrix that's out there. And we blended those economics together and the risk associated with those two. And then the other 2 asset classes that we're focused in to sort of balance against the VC arm is venture debt, which is a hot and heavy asset class, especially with the rise of interest lately and the difficulty in getting access to capital. It's an easy way to have sort of a return on and a year over year or even quarterly return on that investment. And then lastly, the tried and true real estate is in the matrix too. So the matrix or the venture debt and the real estate make up about 20% each. And with the way that we've got risk structured in here, if we just absolutely bombed it on the VC side, we'd at the minimum double or triple an investor's dollar throughout the 10-year fund with just the venture debt and the real estate and the equity year over year across that 10-year period compounding itself. So I know that was a lot, so I'm going to take a breath here and anything you want to unpack there?
Yeah, no, that's all good stuff, right? Because you're giving yourself multiple mechanisms through multiple investments. And I kind of want to hop right into the venture debt side right now. Would you say you're giving your portfolio companies when you amass those more options? Because a lot of the times, you know, people might not always need equity taken out, aka people paint the picture of expertise. Some funds aren't benevolent in that case. But if they just need the venture debt without the equity, I'm assuming that's a capability that you're just giving people options for, or is that something that you've already had built out?
So we would partner with somebody that's got that fund. So I need to apply a little specificity there. So it's more like a bank in the sense that they have you know, high interest rate loans. They're typically 17 to 25% because oftentimes these startups don't have either or limit run a volume of business standpoint. And so this is, for all intents and purposes, bridge loans that allow them to get to their next raise. There might be, you know, the folks that I'm talking to that have the fund for this and the access to that are incredibly smart people, and they have to be, because the amount of risk that they're juggling comparatively to something like real estate, or you know, even in some instances like a emerging managers or a venture school type ecosystem on the VC side, is just a totally different ballgame because they have a vested interest from an equity standpoint, like you were talking about. So it does take that mindset of an investment banker, that mindset of somebody that's dealt with high risk traditional investments and how they apply that to companies. So it's a phenomenal asset class just from a return standpoint. We're seeing anywhere from 20 to 25% IRR, which is just incredible for sometimes a 9-month parking of that respective investment. So as I said, we're 10 years out. So being able to multiply that out across a 10-year period and rolling that compounding interest year over year is very exciting, provided that venture debt continues to be a fairly liquid asset to be a part of, which is another great value.
Yeah, and yeah, that's not to crack too many jokes here, but with the medium to larger tech innovation banks being under fire right now, or just closing down, yeah, I feel like there might be a good time to kind of take advantage of that. Kind of a crude joke, but that's the world that we're living in right now. So
You're right. Yeah,
yeah, I mean,
exactly.
never in my life would I mean, I'm 27 personally, but just seeing like all these characters either get merged or shut down, and like imagine what that's gonna look like in 10 years down the line. We're gonna be talking about completely different players, and I'm like things like Credit Suisse and SVB threw me off big time. I thought they were gonna be around forever, but that just shows you the volatility. And that shows that startups kind of can't rely on one massive entity, because then you have stuff like that happen. So I guess I'm gonna kind of lead off to the last topic, and one that I care about and I ask every single guest because this isn't going away. So in regards to diversity of underrepresented populations in venture capital between women, people of color, underrepresented founders, investors, it's a whopping 4%, and that's a maybe in the United States. And what's your take on that? And what do you think all are the steps forward to kind of even things out that kind of gotten misconstrued because of the history of this asset class?
That is a hell of a loaded question, Chris. But I love it because it does segue very well into the emerging manager bucket that we've been talking about today. And in expanding that horizon, I think that's at the forefront of many of the assets that we're specifically targeting. So, at least from Echelon standpoint, generally speaking, we're agnostic from a specific vertical that we're targeting. So we've spoken to a global fund that has many of those emerging managers, emerging verticals as far as countries go. LATAM is a huge market right now, and just trying to explore other options outside of grudgy white folks that tend to be at the forefront of all these. So I think we're poised in a very unique way to continue to push the boundaries of traditional VC, traditional investing, and you're starting to see that even in market-specific funds, that is the specific asset class they're targeting. As I mentioned, I'm agnostic. I mean, everything that I do is performance-based as far as that goes. So I've got to just be upfront and honest to say that I'm here to return capital as quickly and as maximized as possible, and I'll do that by whatever means necessary. That is my fiduciary responsibility, and I'm excited to see how that fits into the matrix with the funds that we've targeted that we want to invest in, because they do all have some sort of DEI component to the way that they're looking at the world, and we get to effectively marry that and compound that in our own fund with Echelon.
Yeah, no, and I just like hearing it from like all the other funds because a lot of funds do have DEI initiatives. Like I was just talking to on this podcast, Sputnik ATXVC, like they like 50% of their portfolio companies and their management team is like from diverse or women, and they have like a 15% IRR. Like they're doing proportionally, they're doing just as well as A16Z, but as a smaller fund in Austin, Texas. So I thought that was cool just seeing like what everybody's take is on it. So guys, with that being said, we're going to wrap this up here. I'm going to have all the info for their fund in the show notes, to include Jeff, who might be the most entertaining and funny guy on LinkedIn. I keep telling him to get his own podcast, but I don't think he's down for that. But hey, him and Joe Rogan would have chopped it up really well. And guys, I'm going to, at some point when the Echelon Fund gets up and around, along with like Vibranium and Pegasus Tech and A16Z and all the other people that we see on our virtual pitches, I'll probably ask Hanson or someone on his team to chop it up with you guys. So yeah, guys, I'll see you on the next one.